We have with us right now Dr. Soumya Kanti Ghosh, Chief Economic Advisor at SBI. Thank you very much, sir, for being with us here on NDTV Profits. It's always a pleasure to have you on the show. Wanted to talk to you about the kind of measures now the government is taking as far as revival of the road projects, the stalled projects are concerned. They've recently in the cabinet approved the hybrid annuity model as well, which eventually will make things easier for banks which have got stressed balance sheets. What are your views on these kind of measures? Do you think these will further accelerate, this momentum, positive momentum that has now started building up?
Yeah, good morning. I think the hybrid annuity model, which has been is now operational for these road projects. I think that's a very good step, because in India you see that the model which has been in existence, it doesn't exactly work. So it is now a mix of the toll project and it's a combination of the annuity and the toll. So I think that's a good policy which the government has taken. But the only thing is that we have to be a little bit patient, because all these policies in terms of initiative of the smart cities, then the roadways projects, the infrastructure push, I think all of this takes a little while to see the impact on the ground. So if you want to see the impact immediately tomorrow, that may not be possible, but maybe 5 to 6 months down the line, you can see a visible impact on the sectors of the economy. And the other thing is that these roadways, the highways are always employment intensive. So that is also going to help in terms of job prospects for the economy as a whole.
Right. But at the same time, ever since the government has come to power, we've just been talking about how they inherited economy in shambles, and they have been trying to take small and little steps to, get it out of there. We've been waiting for things to really recover. Where do you think things really stand at this point in time? Do you think recovery has now started coming out, looking at the third quarter numbers that companies are coming out with?
I don't think that I think the economy may have bottomed out, but as of now, I think, for example, if you look at our index for the month of December and January, and the IIP numbers will be out later, doesn't look too encouraging. In fact, we are seeing a little bit of contraction on the ground. So I am not very optimistic of an immediate recovery, because I think what has changed in the last 1 month or so has been a dramatic overview of the global economy, and every day you see that the IMF is actually revising downward the projections from 3.9 to 3.5 to 3.1. The World Bank is even lower at 2.9% the projections for this fiscal. So I think the global economic prospects are actually turning for the worse. The only good thing is that the Chinese markets seem to be stabilizing, but none of us are sure that when China will come out with the next round of the renminbi depreciation. And I think on every count, if we look into the data, I think there is every possibility that the Chinese currency could actually weaken further. So if all these factors, and also the Fed commentary, if we have looked into a couple of yesterday which was released, it clearly doesn't say anything about the rate hike of the Fed as of now. It will only say it will look into the immediate future and then look at what is happening on the ground. So if you look into all these pictures, I think that is going to have some debilitating impact on the economy as a whole, because our export growth has also not been going. So I will not be surprised if the numbers, if the third quarter corporate numbers comes a little bit weak, and possibly, and also the fact that the banks are now actually trying to clean up the balance sheets. So that is another aspect we need to take into consideration. So if you take all these factors into account, I think recovery will have to wait for a couple of months more before we will see visible improvement on the ground.
So visible improvement clearly is yet to take place. We'll talk about how banks are really cleaning up their balance sheet. But before that, on 2nd of February, we've got the RBI policy. Firstly, what are your expectations from the RBI governor and from the US Fed as well, considering the kind of commentary that we got from the FOMC statement? How do you see US Fed really moving, and hence how do you see RBI moving in the year 2016?
See, I will see a very peculiar situation as of now. I think if I look into the US commentary right now, perhaps the Fed is thinking twice. I mean making an observation is whether they actually were correct in raising the rates in December. Because if you look into, for example, Bank of Japan recently said it will go for a -1. Then there has been commentary by Mario Draghi, ECB. So all of these central banks are actually seeing that the global economic growth is faltering. So possibly the US Fed may have been, I'll not say the word pushed, but may have been just prompted to go for a rate hike, which may not be in sync with the realities. And in fact, even if you look into the US data, the numbers actually suggest that mixed signals. So my sense is that there will be, the RBI will take all these global factors into consideration. It will possibly go for a status quo on February 2nd. But the other thing is that if the global economy continues to fall, if the oil prices see dramatic collapses, and now a lot of people are saying that oil could even go to $10 a barrel. So if that is the case, I think there is no reason to believe that there could be room for more monetary accommodation going forward. And this time the policy, perhaps the size of the accommodation could be larger than what we are looking as of now.
So, one, you're saying that status quo on February 2nd is something that you're expecting. And second, for the year also, do you think RBI to remain, in this status quo mode, to maintain the status quo? Or do you think there would be a little room for some easing, considering how inflation has been pretty much under the RBI's level, and everyone's believing that, inflation will remain within the RBI's target that has been set? So, in 2016 as well, are you completely ruling out any sort of an easing by RBI?
No, I am not ruling out. In fact, I am waiting for the budget numbers, and RBI will also look for the budget numbers, and I will not be surprised if the RBI actually goes for an off-the-rate policy cut after February, and so that could actually happen in March. But if I rule out that, the moot point is that not the timing when the RBI will cut for the rates, but the cut is going to happen sooner than later. So, and the other thing is that the inflation trajectory, as we see now, is going to be relatively benign even for the course of the next fiscal, because oil prices, commodity prices, all of them are at multi-year lows, and there is no reason for oil prices to believe that they will actually go up. So if you take all these factors into consideration, our projection is that inflation at worst case could be a little above 5%, and possibly it could hit below 5% over the course of the next fiscal. So if that is the case, then I don't see any reason why the RBI will go for some more round of rate cuts. Whether in March and April, that's a call which the RBI needs to take. But rate cut for sure is going to happen in the next couple of months.
Right. Mr. Ghosh, what do you make of the earnings that are coming in so far from the large corporates? Do you think there is a sort of recovery that we are seeing? Because the underlying economic data suggests a recovery. However, it's not translating into large corporates and numbers coming in.
See, one thing which I would like to tell you, Pankaj, is that in this case, that if you look into the second quarter numbers, I have not looked at the third quarter numbers in very minute details, but what I can understand from the second and the third quarter numbers is that there has been some improvement in the margins, and the margins improvement, that is a welcome thing, but that has purely happened because these input prices have been declining now for nearly a year or so. So that's the only positive thing, that the margins are showing a little bit of improvement, but a sharp improvement or a significant improvement, I still believe will take some time to come, because all corporates as of now are still showing some sort of stress within the system, and I still believe that the stress has not completely gone out of the system.
Right. RBI has come out and given directive to recognize a lot of provisioning, a lot of NPAs for some banks. We heard ICICI Bank yesterday. We heard Axis Bank earlier. Do you think asset quality, the corporate asset quality, will be the key to watch in 2016 for better growth?
Yeah, I think asset quality has been an issue with the banking system, and I don't think that things will improve dramatically, but things are actually bottoming out, and so that's the good thing. The other thing is that at the end of the day, we need to look into we look into options whereby the banks actually could clean up the balance sheets and move further. So there has been a lot of discussion in the space that whether we need a bad bank regarding that, but I strongly believe that the banks, the amount of stress which is still sitting on the bank balance sheet within the financial system needs to go, and that needs to go quickly if there has to be some visible impact on the ground. we can have this system of provisioning the banks clean up the balance sheet. That's good for us. That's good for everybody. But at the end of the day, if you look into the experience of 1997, when the gross NPA of the banking system was around 16%, it took 9 years for the gross NPA to come down to 5% in 2006. So if we are in a similar predicament right now, in 2011, the bank's balance sheet have been stressed. If we just allow the balance sheet to improve, assuming the economy will recover, the time taken could actually be still on the significant larger side. So it could take another 3 to 4 years for the banks to come out of this stress. So I think some dramatic things needs to be done, and possibly the government is well aware of this situation. The bankruptcy law is soon coming into the picture, and I think they need to, if possible, they need to look at some alternative solutions like a bad bank, a resolution mechanism, and other things.
The point that you made about bankruptcy laws, about laws changing, you think that will be an important expectation for the budget, because a lot of provisioning is now done, a lot of provisioning is being done, so that is something which will lead to both the things, capital allocation as well as laws that are needed for bankruptcy code?
No, of course. I think that the proper bankruptcy code is required in the Indian system, because the Indian system, the judiciary system, if you look into the link between the banking and the judiciary system, there is a missing link. So it is not as effective as in other countries like US, Sweden, whereby you can actually punish the defaulters and move forward. In Indian case, that is not the case. So I think a strong resolution corporation, a strong exit mechanism, and a strong bankruptcy law, which the government is actually trying to push, needs to be the need of the hour, so that the banks can actually move forward, and these are going to be long-term solutions. So this is not going to be short-term solutions. So the point which I was trying to make is that all these are extremely good steps over a point of time. So maybe over the next 1 year or 2 years or in the future, it will ensure that the bad loans doesn't become a recur in the banking system. But as of now, we need some sort of a mechanism, enabling mechanism quickly, so that the banks can clean up their balance sheets and then move forward. Otherwise, the time taken for that exercise to happen could actually be much longer, and that will not be good for the financial system as a whole.
Right. Till now we've seen the private sector banking doing very well, taking the economy higher, led by the retail loan growth. You think once they have to recognize, once they have to, start providing for these NPAs, capital or the cost of capital for them may also not be particularly cheap, and that can lead to an overall slowdown? Because till now, for last 3-4 years, they have been constantly growing 15-20% plus on a year-to-year basis.
See, it is. I don't want to comment on the banks in general, any of the banks or private or public as such. But my only point is that the retail, as of now, the retail sector looks the only sector which is growing, and that is good for all of us. But at the same time, I think the point which you made is that the capital which the banks require, as of now, the government has allocated 70,000 crores of capital over the next couple of years. I think that number may be inadequate if the banks need to grow at the rate which they are growing right now. I mean, even if you look into the entire banking system. So I think there has been already talks on that their capital infusion could be larger, but how much larger? That will also depend on the fiscal space which the government has, because I think that's a major problem as of now, because of a limited fiscal space, the government cannot allocate a significant amount of capital to the banking system. And if we look into the experience of the other countries also, there has been capital infusion, but that has been on a large scale. China, for example, looks the most obvious example in this case.
Right. Talking about how things would turn up. So we have seen the economy picking up. Earnings, as you said, may pick up at a later stage. But do you expect the government reform process to continue to get that confidence back, to get that investment back? The reform process has to continue. That cannot go on a back burner. If that happens, then investments may take a toll.
No, I think reform is a continuous process and the government will continue to do that but the only difference is that the government is doing the reforms in incremental steps, small and incremental steps. So a lot of reforms have actually happened on the ground. But the visible impact of that, as I have repeatedly pointed out, will take some months, because if you do a GST tomorrow, everybody will take notice of that. But if you are doing small reforms, for example, like the financial inclusion, the power sector, addressing the power sector problem, addressing the coal linkage problem, the insurance issues, so agriculture, the Pradhan Mantri Fasal Bima Yojana. So I think all of these are very good steps, and I think the government will continue in that direction in the coming budget also.
Right, so of course budget is going to be really critical going forward, and all eyes, all economists, all experts are going to keenly watch the budget and what really comes out of it. But as Mr. Ghosh was also telling us that now RBI is also expected to act. They're also expecting, once the budget exercise is over, then an off policy rate cut is something that we may see coming through. But at the same time, we'll also try to understand from Mr. Ghosh that what's happening as far as the credit offtake is concerned. So, Mr. Ghosh, the credit offtake, that still remains at a very low level. So, we've already got a rate cut of about 125 basis points from the RBI. What are the other factors which are still holding back the credit offtake at this point in time? Because, people till last year were asking for rate cuts, more rate cuts. Now, they have got enough. Now, still the credit offtake hasn't really happened. What's your view on that front?
See, I have a little different view on that. I agree with you, but also to some extent there is a disagreement. If you actually look into the credit data in the last 1 or 2 months, I think credit data has visibly picked up. Even though the number is still in low single double digits, I think still the credit number has picked up. And the good thing is that, I'll not say a good thing, is the credit growth is now outpacing the deposit growth, but it was not earlier. Earlier the case was exactly the opposite. So that's a positive thing. Regarding the other thing, and the point is that the credit growth is still not satisfactory. It is in single double digits. And the problem is that there is not enough demand from the corporate side. Most of the credit demand which is coming up is actually because of refinancing of the existing loans. So if that is the case, if you are refinancing of the existing loans and there is no visible demand, the only demand which we are seeing actually is on the retail side. For example, in the month of October and November, there was a huge uptick in retail, which is now some sort of stabilizing. So as long as that demand doesn't pick up, I think we are still in a scenario. And again, if I look back and take the examples of 97 to 2006, at that time also we were in a similar predicament, but we actually went ahead. There was a two-pronged strategy. The first was a top-line growth, because the global growth was coming up, which is not happening as of now. And the second was the amortization of the debt, because at that point the Reserve Bank had actually cut rates by 500 basis points over a period of 3 to 4 years. But given the fact that it cannot happen right now because of the inflation scenario, I think the credit demand will only come back slowly into the system, and not very soon. So my sense is, again over here, is that as long as the stress is there on the corporate balance sheet, we'll continue to see a credit growth which may be a little bit muted. But the only good thing about the good credit growth is that the next cycle, when we are ready to grow, the growth of this credit will be much better than what we had in the last cycle. But as of now, I don't expect any visible improvement in the credit growth. It could be still in the low single double digits.
We need to really wait for fresh corporate credit demand to really come at this point in time. You've also written a blog as far as infrastructure financing, or rather this refinancing that's taking place using 525 scheme is concerned. What's your view on this? Is it just postponing, or rather pushing these bad loans to the later, to some later years, or is it actually solving the real problem? How do you really view these particular schemes which RBI has come out with? Would they be actually helpful in cleaning up the balance sheet, in relieving the corporate side of the kind of stress that they are seeing on their balance sheets as well?
See, I just need to clarify two things over here. There are two schemes which are running right now. One is the SDI, the Strategic Debt Restructuring, which is actually a restructuring scheme whereby the banks are actually taking over getting into the corporate the management space. The other thing is the 5 into 25 scheme, which in the strict sense of the term is actually refinancing. And if you look into the example, there is a classic example of a 2008-9 deal, the CGPL Mundra deal, which was exactly 5 into 25 scheme, and that happened in 2008-9, which got the best Asia Pacific powered the project finance deal. So my simple point is that, and if you look into the RBI circulars on this 5 into 25 successive circulars, it clearly says that it has to be refinancing after a certain period of time only if some conditions are met. And the conditions which is laid down over there are actually quite stringent and strict. For example, one of the conditions is that a proper techno-economic viability of the project has to be undertaken by the by an independent evaluation committee, so that it qualifies for that 5 into 25 scheme. So my sense is that this scheme is actually helping the system, so that for some of the existing loans to be refinancing in a proper way, because as you know, in Indian context, the banks have the banks liabilities is around 5 to 7 years, and then tend to finance that with an assets which are more than 10 years. So from that point of view, 5 into 25 is a very good initiative which has been taken by the RBI. And I think that we need to make a distinction at some point of time between restructuring and refinancing. SDR is a proper restructuring scheme, but 5 into 25 is a refinancing scheme.
And you're confident that banks will be able to clean up their balance sheets by March 2017 as directed by the RBI?
That's a mandate which the RBI has given. So if that's what the RBI is saying, I think that will happen over the next 1 year or so. So I think that has both a good and both aspects could be associated with it. I think once the banks are through with that, it will be good for all of us. But in the short term, we may actually see some sort of pain happening in the banking system.
All right, Mr. Ghosh, we'll leave it there. Appreciate you joining us here on NDTV Profit and sharing with us your views on a lot of topics, from the stress in the banking system to what we can expect from the RBI governor, and of course the expectations from the budget. Appreciate you joining us here on the channel today morning.